Yeah, good afternoon and welcome to another presentation within the CFS Chief Economist Seminar Series. We're very glad to have you here in our seminar on this very sunny afternoon. We know that there is a lot of other possibilities, but it's great to have you all here. In particular, our speaker. Very warm welcome to Ludovic Subran, the chief economist of Allianz since 2017, and at the same time chief economist of Euler Hermes already since 2011. Mr. Subran graduated from the École nationale de la statistique in Paris and also from Sciences Po in Paris, where he still has a position as an adjunct professor, at the same time also at HEC, one of the most renowned business schools in France and worldwide. He has worked for the French Ministry of Economics, for the United Nations, and for the World Bank before joining Allianz and Euler Hermes. And we are very glad that he will talk today about the craft of central banking, not the art of central banking, as we already noted, the craft of central banking at a crossroads, certainly one of the most pressing topics that we currently have in macroeconomics. Alors, Monsieur Subran, on vous écoute. Soyez le bienvenu.
Merci, danke sehr, Frau Klum. Das ist mir eine Freude, hier zu sein. Ich werde mal meinen Vortrag auf Englisch halten. Das ist besser für Sie und auch für mich. So you mentioned it in the introduction. I'm super happy to be here today. I'm sorry I'm not in Frankfurt. And I'm also very happy that people are joining in spite of the nice weather, right? So I will share some slides about the craft of central banking, which is, as you mentioned, a very timely topic. And you can see my slide, right? Very good. So I have approximately 30 minutes, and then the most important part is, of course, the Q&A. I will maybe talk a bit. Go ahead, yeah.
Maybe before you start, let me just remind everybody that for questions, please use the Q&A function in Zoom, and we will bring in the questions then from there. Thank you.
So the idea is maybe I will talk a bit about the current outlook, and then I will dedicate a specific section about the craft of central banking, or at least what are the challenges posed by the current situation. I must say, maybe in introduction, that I myself I'm quite surprised by the current policy debate. I think it's high time that the central banks stop doing maybe the heavy lifting, but I don't see the fiscal side necessarily taking over as much as they should, when we know that the energy crisis that we're getting from the unprovoked attack of Ukraine by Russia is creating a very difficult moment for the most vulnerable people in Europe. And so maybe I will talk also a bit about this, the trade-offs that we're seeing and the difficulty to be a central banker today. Is something that in my 20 years as an economist I've rarely seen, right? So I was not there. I was not an active economist during the Volcker times in the early 80s in the US, but there is a feeling a bit of the early 80s when it comes to the decisions that central banks have to do, and of course the other policy toolbox to enact to make sure that we navigate this crisis. So maybe a quick word about the current environment. This is maybe the summary slide of what we see, and I've highlighted the monetary policy expectations. Very early, on the 24th of February, because we are this global financial company, we had to come up with, what does this war mean for economics and capital markets? And we came up with three scenarios. I will unfortunately only focus on the escalated conflict and the blackout scenario. And so we said, okay, we think that what is happening against Russia is not necessarily a systemic crisis per se. It is about making sure sanctions work. It is clearly something new. It is a financial weaponry, which is something quite different than what we've seen in the past sanction waves. But what is important for the West is clearly the energy crisis that ensues, and clearly this acceleration of what we had before the crisis, which was still a bit of growth, but a bit of inflation. I think in 2020 and 2021, to avoid a protracted recession, to avoid bankruptcies, to avoid unemployment, central bankers and ministries of finance have decided to do what I call the great intervention, which was, avoiding an Armageddon on the capital markets, on liquidity, and certainly scaring effects on people and companies. They created more debt and more inflation. And when the crisis in Ukraine happened, this exacerbated, of course, one very important situation, which was, what do governments do? What do central banks do? So the policy trade-offs were completely put back into discussion. And of course, how much more inflation can investors, households, companies swallow? And this is why this energy crisis, in the end, created this risk of a stagflation scenario. So here you see a bit our current expectation, which is the central scenario. We think the current growth impact is approximately 1 point. The current inflation impact is between 1 and 2 points. So 1 point less on growth and 1 to 2 points extra on inflation. But very interestingly, these questions indeed, what do central banks do, right? So very initially, and I will be very transparent, we expected central banks to save the day again. And we were, I think, very affected or very influenced by the way central banks saved the day in 2020. And so we said, you know what, with this energy crisis, central banks will have to, again, do whatever it takes. And in the end, they decided to follow the course with normalization. So if you remember January, there was this peak hawkishness, markets were expecting central banks to act very quickly. It was a sweet spot for growth. It was a sweet spot also to rein in any wage price spiral. But when the war happened, we said, okay, central banks are going to have to do something. And in the end, they actually, to our surprise, said, no, we have to tackle inflation because we are the only people that can do that. And so that's why we have now this very interesting normalization of monetary policy in a decelerating growth environment. So our expectation today is that the Fed hikes 6 to 7 times this year. We are still much more dovish than what markets expect. We continue to think that the second half of the year and also 2023 is going to be tougher on the US. And so to avoid a recession, the Fed will have to calm down a bit the normalization game. And similarly in Europe, you may have seen comments everywhere, from the governing council about hiking in July, making sure we hike 2-3 times this year. We still continue to think it's going to be hard to pull 3 hikes, and especially a hike as early as July, because of the soft patch in growth that we see in the Eurozone. And of course, I will develop a bit more the policy and the monetary policy angle to this and the trade-offs at play. But this scenario is very interesting for us because it's hard and it's not easy to bet against central banks, right? So you have to be really sure that you try to see through the narrative building. Just like we try to see through its transitory narrative of the second half of 2021, right now we try to see through what we think is a very hawkish moment for central banks, when the signs on growth and the risks of reining in demand on inequalities, on vulnerabilities are still flashing orange lights as we speak, especially in Europe, because we can't defy gravity, but also in the US. And maybe one word on the bottom part of the chart, which is the capital markets outcomes of the situation. You've seen the Bund 10-year testing the 1% mark on the yield. You've seen spreads widening a bit. In the US, we see a bit the diffusion of the hawkishness, of course, on the US 10-year Treasury testing the 3% mark, but also on the credit market. This is something that is creating, as we will discuss also, quite a different rate environment for a moment of very high indebtedness for the public and the private sector. And this is certainly a financial stability trade-off that will also have to be addressed by central banks and by ministries of finance in the months to come, especially in Europe, because of the very different initial conditions for indebtedness, but also for financial stress across countries. One word on the blackout. As you know, the discussion today at the European level is whether we can afford to live without Russian gas. We agreed to live without Russian oil. This is a very complex question. We continue to believe that the effect of a gas embargo will be very recessionary for Europe, and that in that situation, both fiscal and monetary policy will have to come hand in hand to try to avoid that all the nice efforts of the past 2 years are ruined in terms of additional employment and additional bankruptcies. So we continue to believe that should we move into a situation where we decide to cut off the gas imports from Russia to stop financing the war, right? So it's a principle, it's an ethical question, not an economic question, right? We every day are paying $700 million to Russia, right? So we are helping finance, of course, the appreciation of the ruble, but also the war against poor civilians in Ukraine. And so we are, I stand very strongly in the camp of we can do that, wir schaffen das, we can stomach it. Of course, that means we know that we have to handle what will be the impact of that. The cost of the war through inflation, additional inflation in the case of full energy embargo, but also the type of additional public money we need to put into the system to weather the shock on the most vulnerable. As we put a 35% probability to this scenario, but of course, this is very much in flux, and we will see what Europe decides. One word on this, I think it's very sad that Europe doesn't learn from its past successes. I think we handled the COVID situation as one very well, from masks to vaccines to Next Generation EU to the Green Deal to the Central Bank of Europe really defending the euro at all costs. And now it looks like we are a bit more cannibalistic on trying to secure alternative gas supplies. Germans going to Qatar, Spanish or Italians going to Algeria, some turning to the US. I think we can do better than this if we want to be serious about avoiding even more negative effects of a blackout scenario on our economies and our people. So that was the scenario moment. I won't go too much into the details of a growth forecast, just to focus really on monetary policy today, but you can find all our research on allianz.com. Here you have a bit our growth expectations by country. So you see that for Germany, we expect growth to be below 2% with a very soft patch in the second and third quarter. We expect most of the countries to avoid a full-fledged recession because of the resilience pockets. Excess hoarding, savings basically from COVID years, but also some policy reactions to stop or to weather the purchasing power and the margins effect of the energy crisis on economic agents. But of course, this all means that all goes in an orderly fashion. And if there is one thing that we've learned over the past 2 months is that sanctions and counter-sanctions and more generally the political economy of the war is nothing but orderly. So we need to be kept on our toes on these risks of recession, be it in the US, the cracks in the housing market, the Fed really going a bit too far, the resurgence of the US-China trade war, but on the financial account instead of being on the current account, maybe a shutdown because of the midterm. In Europe, clearly financial stress. We have elections in Italy in 2023. We have, as I said, a difficult moment finding our common reactions to the situation. We have, of course, the confinement in China adding up to our problems, especially for industrial hubs like Germany and Italy. So this is a scenario where things go okay. But as I said, the blackout scenario is still very high in terms of probability. And of course, policy mistakes are also one cause or one potential cause of a potential recession in 22 or 23 in the big economies of the world. This is maybe the slide that everybody is most interested in. We continue to think that inflation will come back in check, right? So I think it's, when we are between economists, this is something that everybody agrees on. Everybody says, of course, inflation, just the way we calculate inflation, it has to be transitory, right? Because it's a year-on-year calculation. So at one point, there is a moment where even if energy prices stabilize, this means that the headline inflation numbers are going to go down. And so this is something that we continue to have in our models to get to continue to be at peak inflation all the way into 23, we would need the energy prices to increase by another 100%, right? So that would mean something really massive, right? That would be really a blackout. So in our current forecast, what we have is a normalization of inflation by the end of 23, meaning going back into target. But as you can see on core inflation, there is still some reminiscing effect, right? The diffusion of headline inflation from energy to transport and food and even a bit of services. And we've seen the numbers today in the US, and the semi-durable and durable inflation is indeed getting a bit of speed, even though there is an inflection in the overall inflation numbers. But also the idea that we're trying to avoid a wage price spiral, but we have also to count with the idea that we need to weather some of the inflationary shocks on the economic agents. And so that has a bit of a reminiscing effect of the overall core inflation numbers. And I will talk in the last part of the presentation of the structural inflation effect. Here again, the 3Ds, and so deglobalization and of course decarbonation have some impact on top of demography on the structural inflation outlook. And this is also something we need to keep in mind. We won't be in the next 10 years, just like we were in Europe in the past 10 years, in a structural deflationary environment. Again, one point that needs to be clear, but for me, which is very clear, which is that most of the inflation, especially in Europe, is imported and supply driven. We have no sign of overheating. So it's an energy crisis. It's certainly a confinement crisis in China. The additional zero COVID strategy is creating an additional push of inflation of 0.5 point. And so this is why it's creating a very interesting moment for central banks. Should they hike when they know that it's not necessarily the best policy tool to curb inflation right now? So should they rein in demand? Should they use the bazooka when most of the inflation is not really monetary? And we can discuss that at length. I continue to believe, and just looking at precautionary savings, right? Inflation doesn't seem to be about velocity of money. It doesn't seem to be an inflationary monetary phenomenon. But of course, this is something that is a strong assumption in the current environment. And for us, this is what also explains a bit our monetary policy outlook and the trade-off at stake. The central banks today, if they decide to hike, it's more for credibility reasons than for really trying to fight inflation. They will, of course, have an effect on inflation. Are they the most cost-effective policy tool to use? I'm not sure, because when you curb demand, this is very unequal in terms of distribution of income and in terms of distribution of jobs and so forth. But maybe they still have to do it because the other policy tools in our toolbox will not manage to curb inflation now that we pass in some countries the 6 or the 7% mark. And this is the whole story of today. Do we do it because we think it's going to work? Certainly it's going to work in part. Is it the only and the most cost-effective tool? I'm not sure, but clearly this is the one that we have, and this is the one that we need to use today. I mentioned supply chain bottlenecks. This for me is going to be also one of the most interesting development over the next months. What happens when China exits the lockdown, right? Do we have yet again a reopening effect? So more growth, less producer prices and imported inflation, and therefore a bit of a better outlook for the second half of the year. So that goes into the camp of we can avoid a recession, we can tighten softly. But this is still something that is up for discussion. Why? Because structurally we have not invested enough in trade and infrastructure. And conjuncturally, the Chinese economy is very depressed. And so whatever the Chinese policymakers are doing and will continue to do till the plenum in September will actually have a major effect, of course, on Europe and the US, but also, as you can imagine, on the emerging markets that are affected by the double whammy of decelerating China on the current account and tighter financial and monetary conditions from the US, right? So this is, of course, a problem on top of a problem. But I think this problem at least has an end date, whereas the war in Ukraine does not. So as I said, the big question here is whether central bank, by deciding to hike that much, are they counteracting this wrong narrative building of H2? It's temporary, it's transitionary. Or are they really trying just to show that they have to do something because we pass a specific threshold that means that if they don't do anything, then they're not credible anymore. And so for me, most of the hikes that we are currently expecting are also about credibility more than just about calming down, I think, any form of overheating. Of course, the situation of the US has a different profile. There is overheating, but in Europe, there is very little, if none, overheating. And so it is mostly about credibility. It is also about the US financial cycle, and we are with our back against the wall when it comes to having to tighten because everybody else is doing it, and we don't want to be Japan. But it is very interesting to see when you look at inflation expectations that there is already a deceleration of inflation expectations. And so that means we're going to tighten, we're going to hike, sometimes very strong, especially in the US, at a time when already most of the expectations are already going in the right direction. It's not yet the case in Europe because I think our peak is maybe delayed by 2 to 3 months, but it will come. And so the big question is whether the ECB, when they decide to hike, if they start in September, which is our expectations, will actually do it at a moment that inflation will actually go back in check. So there is a bit this off timing, which is also creating a very bizarre perception on the whole monetary policy path, and which confirms certainly the idea that they have to do it now or they will never do it, which is a very interesting reason or rationale for doing any form of monetary policy normalization after all. One word on the labor market. This is, of course, one of the most looked after topic, both in the US and in the Eurozone. In the US because it's in the mandate, in the Eurozone because it is, of course, a very important element of the whole overheating dashboard. So labor markets are doing okay, especially in the US. They're doing fantastically well, even I could say, with the unemployment rate at the record low. There is this talk about great resignation, which is not something we particularly buy into for reasons I can explain. In Europe, what is interesting, and you have it here, is there is this expectation on wage negotiation that is, of course, the crux and the matter of the whole risk of wage price spiral. Why is it more important in Europe? Because in big economies like Germany, like France, like Belgium, you know, the wage price spiral, when it is activated, is much stronger than in economies like the US and the UK because of the rigidities of our labor markets. So this is what you find, for example, in Isabel Schnabel's speech. The whole idea is to do preventive hikes to avoid any form of triggering of the wage price spiral. Right? And people could question if this is really the right way to do, or whether a bit of wage growth in Europe could actually be good. And this is maybe what you have on this chart. There is this on the left-hand side of the chart, you have on the x-axis the forecast for inflation for the big Euro 6 countries for 22, and you have the wage growth forecast bias for the big Euro 6 countries. What you see is a bit of rebalancing between the beer drinkers and the wine drinkers. Right? A bit of this idea that somehow, maybe it is good to have a bit more wage growth in Germany, in the Netherlands, and a bit less wage growth in Italy and France at the moment when we need a bit of rebalancing of competitiveness and we have these big current account imbalances. Similarly, and you have that on the right-hand side, there are a lot of talks about central bankers, especially in Europe, being very vocal to avoid euro-dollar parity. I think it's always very hard to say that the ECB is focused on the exchange rate, but as you can imagine, below $1.05 for €1, we have a bit of an issue because very quickly we move to the parity, and this is something that is complicated, of course, because it aggravates a bit the imported inflation effect, but also because this is the whole idea of defending the euro also goes the other way around, which is, do we want really to have a very strong depreciation of the euro? Some people, again, in the rebalancing camp may say, it's not too bad because that will help with the current account surplus. But and maybe in the future with competitiveness, but other people may think it is actually not good to have a lower purchasing power for the entire zone at a moment of a global crisis, especially on the commodity market. So this heterogeneity in the Eurozone is, of course, adding to the very difficult task of the ECB. And this is something that we need to continue to look at, because I have the feeling, and this is not an empirical comment, that there is a bit of this hesitation also in the governing council of the ECB between the dovish, Philippe Lane and the more hawkish members of the governing council, between those countries that can afford to have a bit of overheating and those countries that cannot. And this is a bit the catch-22 of the governing council as we speak, and why maybe we see a bit more variance in the proposals and the way the monetary policy is communicated, or the expectation of monetary policy and the guidance is communicated to the market the past couple of months. So as I said, central banks are extremely obsessed with inflation. They got back their obsession, their determination to fight inflation, to the point that markets are really testing the universe of outcomes to a point that is unprecedented. That creates, as you can see, a lot of bond market volatility. This is very interesting to see whether this will stick, whether at one point growth will not, or less growth will not bite this price stability obsession in the back, whether financial stress, whether financial stability could also at one point come back in the center stage. Right now, it's all about inflation, and it's all about making sure that it is strong and it is neat and it works. And so this is something that we haven't seen at least since the early 2010 in Europe. And so, of course, it is creating a very different market environment, but also economic environment for economic agents, the states, especially those that have a bit overused the fiscal capacity for the response against COVID, and now for the fiscal response against the energy crisis. So in my country, France, we're going to spend 2 to 3 points of GDP to fight the effect of the energy crisis on the purchasing power and margins of companies. In Germany, it's less than half a point of GDP. So you see the very different trajectories when it comes to debt and debt sustainability. But also, whether the situation that we see today is something that has put a stop to the Faustian Pact, or the role and responsibilities decomposition between monetary and policy and fiscal. Whether actually central banks have done a lot, now it's up to fiscal to do whatever it takes, again, to which point, how cost effective, while central banks are just doing their mandate in a very narrow sense. I've talked about the hikes already for the US. I've talked about the recession risk, the stagflation. Maybe one word, and I will go now into the policy or the rules and the craft discussion. One big question that one can have is, where does the neutral rate stand in both the US and Europe? Whether policy tools, rule-based policy tools still work, whether we have a good estimate about when does the Fed will actually cause monetary and financial conditions to be recessionary in the US, and whether we have a similar estimate for that in Europe. So here you have, I would say, a range for the policy rate from the literature, but also what our term structure models give us. And what you can see is there is a bit this sweet spot in the US between 2.5 and 2.75%. So that's something that the US in the current hiking expectation could reach in the fall. And for the Eurozone, there is a sweet spot, or I would say a threshold around the 1% mark, which is something that we should reach in 2023, right? Even if we were to hike 3 times, we won't get to, I would say, recessionary financial and monetary conditions by the end of this year. But of course, this is, without the undue tightening that we import from the US, which is, as we can see today, one of the reasons also behind the very difficult or the much tighter monetary and financial conditions. We haven't really started to hike. We've anchored a bit the expectations on the path between quantitative tightening and the rate hikes, but we have this delay with the Fed, and so we are a bit, as I mentioned before, with our back against the wall. Whatever the US financial cycle is having an effect a bit on our undue tightening in our Eurozone. So for us, September, October will be a bit critical. Can the Fed push a bit the button too much, or by then will everything be normalized? And similarly for Europe, if we start in September, we could start in July, but by September, will it still be marginally good for Europe to hike at a moment where maybe the Fed will slow down its hiking path, and maybe the European economy will be in a different shape than it is today? And this is a bit the question of timing and the question of window of opportunities, of course, the most important, I would say, being discussed today by central bankers. So the question is, indeed, I mentioned the policy rules, whether we can go back to the way we used to do monetary policy, which was rule-based. Here you have a few of the rules and that are used or that used to be used, and those that are to be used now, just like the average inflation targeting in the US, and whether these policy rules, Taylor rules, augmented Taylor rules still work in understanding what monetary policy is doing, right? Especially because the unconventional part of the toolbox has become so important, and the balance sheet intervention has become so important that maybe everything is distorted, right? So we have a deforming glass on the way this policy rules work in today's environment, with a very different neutral rate, with a very different relationship between financial markets and their expectations on central banks, and therefore how central banks have an effect on the economy. And this idea that the independence of central banks from politicians is one thing, but the independence of central banks from financial markets reactions is another thing, right? In the US, in our models, for example, we have used volatility suppression as one of the determinants to understand what the Fed is doing. And we were very surprised, actually, that the Fed continued the course of hiking in March and in April, in spite of the very strong equity market corrections. Similarly, in the Eurozone, today the banking sector is okay, but should the banking sector or should the bank sovereign doom loop be reactivated? Will the ECB continue to hike? At a time when maybe the financial stress on countries like Italy could be at peak? This is one of the questions that one could ask about whether these tools still work when we've been intervening so strongly on the market by, again, and today, and just to give you an idea, the ECB represents 28% of all government bond ownership. So it is a major, if not the most important actor of the financing of debt by the governments. And of course, you can look at the rates and maybe they can hike once, twice, thrice. But the big question is, what do they do on the balance sheet? And this is the type of trade-offs we're going to have to look into. I won't spend too long about the negative supply shock world, but this is really the worst moment to be in, right? We are in the upper left quadrant of the world. We have high inflation, low output gap. Do we really want to stick here? No. And so whether we have to do something on both the monetary and the fiscal side, can we get out of that with more growth instead of less growth? Can we make sure that we can curb the unintended consequences of this energy crisis, especially if it's there to stay, if there is high and volatile energy prices for years to come? This is the big question for policymakers. And why do I say it's a new era for policymakers? Because one of the problems I think we see is that central banks, just like ministers of finance and so forth, are pushing the policy toolbox to the midterm when they are actually only good for the short term. When you hear central banks saying we're going to do something for climate change, when you hear about planning for ecological reasons, I always have a bit this worry that policymakers overstay their welcome in the state of private affairs, control markets too much without really having the tool for normalization and stabilization. So for me, this is always the problem, is that we're trying to normalize something in the midterm when basically our policy toolbox is good in the short term. And this is creating maybe the cognitive dissonance we feel right now about the effectiveness, credibility, capacity of policymakers to help in an environment of higher inflation and lower growth, which is, again, the worst place to be. So I mentioned the 3Ds. And so talking about the structural effects beyond the short-term inflation development, the big question that people have is whether inflation could structurally jump, like could we regime change, and whether this is something that central banks could address. I continue to believe this is not the job of central banks to address this midterm inflation concerns, but clearly this is a bit what we feel, that there is this fear about the midterm issues. On the demography, I continue to believe that the demography is deflationary structurally. There are a lot of people that talk about the working age population and the Chinese not, being able-bodied and contributing to the labor supply. I still have a hard time with that argument. So I'm still in camp. What demography is pushing for us, life cycle. And I would even add wealth to this. In a country like Germany, more than 60% of the wealth from inheritance is accumulated after 60 years old. because of the of longevity, and also because of the current inheritance, mechanisms, right? So I don't believe that this will be inflationary by construction. Right? Deglobalization, yes, we are deglobalizing Russia. Yes, we live in a frictional world. It's not the heyday of globalization of the early 2000s, but I continue to believe that we have strong globalization, and that globalization is in a sense deflationary. Of course, this is the first time in 20 years maybe that China is exporting inflation. But again, is that something that is structural? I don't believe so. I continue to, you hear about reshoring, and you hear about, there is, of course, protectionism, and there's been more since President Trump came to power, and there's been a lot now of thinking around financial balkanization. But I continue to think that globalization is midterm deflationary, and that what we see today is really a bit of an error in time, or a deviation from the trend rather than the new trend. One on the last D, which is of course the most interesting for me, where I think the jury is still out, but of course we are more and more in the camp of decarbonization being inflationary. It is very complicated to assess something that is not empirically proven, very difficult to prove today, even using carbon price and so forth. What we see, or what we expect, is that, and I have here a stylized Phillips curve on the right-hand side. The big question is whether the Phillips curve is back. I think we all see that, but whether the Phillips curve is steeper or has moved up here. So this is a bit the 1 and 2 here. So whether deglobalization, less competition, so the structural aspects of price fixing has changed and has steepened a bit the Phillips curve, or whether there is a shift towards a different level altogether with a negative supply shock. I think we're more in the shift that can de-shift, but the question about the third D could actually make us in a different inflationary world altogether. So I mentioned this idea that the deflation decade is behind us, and clearly with higher and more volatile energy prices, with the equilibrium interest rate that maybe has moved also on the back of a faster transition, with whatever investment we need to finance for the transition and the reallocation of resources, this needs a bit of overheating, and this creates a bit of overheating. So I still think that indeed, yes, we may have 1 point extra of inflation structurally over the next 30 years coming from decarbonation, and the question is how do we make it work without too many losers, right? And this is the big question that I think we don't spend enough time, the question of the just transition, especially what do we put in place today to avoid having to put blanket subsidies on fossil fuel, but that we rather work on how do we target the right social transfer, social security for the just transition is really a question, at least for Europe, that should be more burning than today. But also at the national level, what do we do, or what are we ready to do to really offset some of the cost of decarbonization on the poorer? We need a Churchill moment. It's going to be with tears and blood a bit, but today we have a bit of a happy decarbonization story when it's not that happy, right? So two last points, and then I will close here. The first one is, even if the ECB hikes, even as the ECB finishes with quantitative easing, what happens when there is another financial stress? Yeah. So can the ECB think already about a standby facility to close spreads again? Should we have another episode of financial stress in the Eurozone on a specific country or on the overall zone, right? And this is something we need to really start discussing now, rather than having to put it in place at the last minute when it's a bit too late and the financial stress has already hit the public finances, but also the psychology of most of the investors, right? And again, I think here about Italy, I think here about 2023, there are elections, they're going to be rocky. I think we need to start thinking about this now instead of having to postpone this discussion, right? And so the question is whether we have already with the PEP, the Pandemic Emergency Program, something that is an ersatz of what we want, or whether we need to think about something else. This is really up for discussion, but we need to enact it or design it sooner rather than later. As I said, the financial stability concerns is, of course, of interest. This is we've seen already a bit the financial stress coming back. It could be much worse than this, right? And as you can imagine, in my country, France, for example, 100 basis points extra on the OAT is not costing much right now, but in 10 years, it's costing 35 to 40 billion additional cost of financing, right? And so we have the chance to have very low debt servicing costs in Europe, but we know that in the current rate environment, the anchoring, or at least the expectation for our debt servicing costs will be very different. I will maybe, just here you have the chart on the left-hand side where we are today, and I'm not even talking about where we could be tomorrow. Just look about the doubling of the US debts, the doubling also of the more than doubling of the Chinese debt, and clearly the factors on the Italian and the French debt, which are quite consequent, right? Because of the fight against COVID, and now that won't be abated that much because of the fight against the energy crisis, right? And the question about defense, Germany committing to 2% off balance sheet, but 2% of GDP to defense, the green transition, other big transitions, the fight against inequality, the digital and globalization issues. This is a moment where we need to think about how we do that more cost effectively, rather than continuing to push and then having a much more difficult trade-off moment with central banks when it comes to how do we finance without creating trade-offs between cost of debt and education budget, or debt servicing and more hospitals, right? Which is something we have been through already in the Eurozone 10 years ago, so we should know better. So in conclusion, and I will focus on the Eurozone, the trade-offs are summarized here. Central fiscal capacity, we had an Hamiltonian moment. Are we done? Is it a one-off? Or do we really need to think about making sure we have a framework, a menu of policy options at the European level to avoid having diverging debt sustainability issues in the members, because we would address them as one and maybe do it a bit better? Do we want to rethink the rules? And as you know, this is, President Macron had a big speech in Strasbourg where he talked about new treaties, new rules, and immediately there was a very nice communique that from Romania to Sweden saying, no way. Of course, what do we do on growth, which should be our paramount objective rather than only fighting inflation? What do we do to make sure we get out of this crisis of debt and inflation, not with stagflation, but with more growth rather than less growth? What do we do to make fiscal policy much better than it is today, which was, I think, too generous for its own good, both in the US and the European side? What do we do on the standby facility in the ECB? What are we designing already as a crisis tool, a contingency plan for next financial stress? And whether it should be on the TLTROs, so the targeted long-term refinancing operations, or whether it should be, as I said, as a standby facility for those countries, those segments of the bond universe in particular that are suffering the most for additional stress in an environment of normalization of interest rates. I will stop here and stop sharing the slides and welcome any questions you may have. And of course, I sent the slides already to Professor Klum, so I think he will send it also to the participants at the later stage. Thank you very much.
Yeah, thank you very much, Mr. Subran. Maybe before I invite, of course, as well, the audience to ask questions in the Q&A section of Zoom. Maybe in the meantime, as you join us from Paris, maybe one question from my side on the French situation. I was a bit surprised to see in your projections of GDP growth in the Eurozone, the quite drastic fall in French GDP growth from 7% to 1.5%. Is that already some projection you have on the results of the upcoming elections in France and the outcome of that?
my expectations are, I still think that President Macron can have a majority government,
Okay.
even though it's tough at this point to forecast. But I think in France, usually it's very rare that the parliament is not given to the president, even if it happens a bit later than usual. The big issue is
what's the reason for that very steep fall in growth that you.
President Macron committed to very strong adjustment of deficit, right? So the public investment side, the contribution of the public investment is supposed to adjust a bit stronger because we have overshot a bit, right? Remember, we started with the energy crisis measures as early as November 2021. So already by now, we spent almost 3 points of GDP on the energy crisis measures. And so in the program of Macron, at least with the pension reform and so forth, there is also an adjustment, I would say, on the overall fiscal profligacy in France, right? I don't know if this is possible because the problem is the conditionalities. If he doesn't pass the pension reform, then, he's going to have to adjust faster on the other fiscal expenditures than if he passes the pension reform, right? But the overall net effect is a lesser fiscal impulse on the French side in the coming 18 months. And something also that we've seen is that the all countries are, of course, very affected in their growth forecast by the European by the energy crisis, right? And right now, what we see as growth is mostly statistical carryover, right? Because we had, 2%, in my country was 2.3% statistical carryover from growth from 2021. But the big question here is the quote unquote doesn't look good also on consumption of services, the tourism season. So the service sector is supposed to have a grand reopening in 2022 because of the end of COVID. We don't see the beginning of that yet, right? So that's a bit maybe why France's GDP looks a bit slower. It's also because the confidence effect, the volume adjustment because of inflation and because of the less positive outlook because of the whole war situation is starting to indent a bit our expectations for France.
Mm-hmm. Yeah, I see. Thank you very much. But maybe coming back to monetary policy, I very much liked what you said on the credibility problem that we have in the short and medium term, and then also the time lags problems that may arrive when now monetary policy in the Eurozone starts to get much tougher. But what would you have advised to the ECB to get out of this credibility problems? So on the one hand side, to avoid that the inflationary expectations grow faster and faster, and on the other hand, avoiding that we run into a recession.
It's very hard because you hear a lot of people criticizing poor ECB and poor Fed. I always try to avoid doing that first because it's very easy to do back trading. When people tell you we should have hiked, in H2 2021, we have to remember where we were back then, right? We still had the sense the virus was still running hot, and we didn't really know if we were expecting to just erase the full effect of the crisis on nominal GDP. So we were just trying to get back to pre-crisis level, not even to pre-crisis trends, right? So I think saying, oh, they should have done it better, I think it's tough. What I would have done, I would have hiked maybe earlier this year and kept a bit more balance sheet intervention. So I would have said, okay, for price stability reasons, I just want to say that I can get out of negative rates, but I still keep a bit of the balance sheet intervention because I don't want to cause unnecessary financial stress or financial fragmentation. That's what I would have done. They decided that this is too sophisticated and too difficult to communicate because the sequence is not right. I still think it would have maybe been better. But again, it's hard to say, okay, they should have done. What is sure now, at least what I'm coming to grasp with, is that even though rationally, I know that the bulk of the inflationary shock is supply driven and imported, and that I know that hiking like there's no tomorrow, even though hiking like there's no tomorrow when we barely get into positive territory by year end is not so much. But I still think it's not super smart, but I think they have to do it. I'm actually surprised positively by the fact that they decided to follow course with normalizing, in spite of the very dovish voices, especially of market participants for obvious vested interest. I think they're doing it right. I think as long as they manage to communicate it well, as long as they explain also the fact that they keep this optionality. Optionality is a big word, but I think they need to make sure that they are credible also in a full cycle of tightening, right? Mm-hmm. What I'm concerned about right now is the whole we hike once and we pause for 6 or 9 months. I'm a bit concerned about this. Maybe this is what we're gonna have to do because of obvious deceleration of growth reasons. So that's my only concern now. Are they really sure? They should really know better, right? So are they really sure that if we start in July, we can really go all the way with 3 hikes till the end of the year, like market expect? This is, because doing the opposite, which is gonna, pause halfway, would be worse than delaying a bit, seeing that we're getting past peak, which again, in the US, I think we are at peak, right? We are past peak, actually. In Europe, I think past peak will be in June or in July, yeah? Mm-hmm. So is it the right time to unleash your full stuff? This is my big question. And again, what I would still continue to do if I were the ECB is just make sure they have some tools to avoid a 2011 or 2012 moment. Mm-hmm. because I think we cannot go back there again. This would be much too costly. We lost a decade in Europe on young people's employment, on growth, on moving politically as one. And so we had a big leap through in 2020. We need to make sure we don't lose what I would call a form of European moment by just not looking at the problem in the end.
Mm-hmm. So let's have a look at the questions. No, so far no question from the audience. Maybe then on your longer term projections, this 3D discussion, I think that's quite optimistic that you don't see any problems coming either from demographics, nor deglobalization, nor decarbonization. Coming to the demographic aspects, wouldn't you see a strong pressure coming from labor markets and wages? We've seen the discussion coming up in Germany that there is a pressure on the minimum wage to increase. Also, the unions are pressing for higher wages. I could imagine that also in France or Italy, other countries in the euro area, that this is building up over the next years, and shouldn't that become a big driver of inflation if there is not a very restrictive monetary policy on the other side?
It's interesting because in my country, for example, we still have 7.5% unemployment.
Yeah.
So I'm much more concerned about what do we do for employability. What do we do on the active labor market policy front? How do we get more people to work? Yeah, then I'm worried about wage negotiation. We have minimum wage, we index it on inflation, so there is a bit of pressure there. We have ways to avoid the pressure on competitiveness, even though it's not working that well. But in my country, for example, and this is the case in a lot of European countries, like especially the wine drinkers, right? Where the labor market's tightness is tight, but at a very unpleasant level, right? We still have in Spain, in Italy, too many needs, right? So these young people that are neither in education, in training, or in employment. In Germany, in the Netherlands, in countries where you have 4% unemployment, and of course the immigration topic is one that we need to discuss, and especially in the frontline workers, those, and you mentioned the minimum wage and the wage negotiations. We have to also agree at one point that the COVID crisis has completely dislocated labor markets in a way that we've never seen before. The exorbitant privilege of executives, which was to be able to work from anywhere, is now being democratized to the entire white collars. But if you're a blue collar, if you're a frontline worker, you have to work on the front line. You cannot be working from home like I do today and delivering food, shipping, doing the manufacturing that you need in the countries, right? And so for me, one of the big questions that we're going to have to do on the labor market tightness today and on the wage negotiation, especially in a country like Germany, which is a very dual labor market. You have the tradable sectors where unions are very pragmatic because it's all about keeping export market shares. And you have the non-tradable sectors with huge productivity issues where you could discuss really the whole, effect of digitalization and so forth, right? So this dislocation, white, blue collars, tradable, non-tradable, training, continuous learning, we need to discuss that at one point. That would also be, again, the central bank has to do part of the job, but we cannot not look at the labor market policies that we have or we don't have that really need a revamp today, from passive, social protection, benefit packages, how do we stay attractive in this current labor market, but also on the active labor market policy, which is especially requalification, recertification, training, and learning, right? So for me, of course, the wage negotiation right now, to be fair, in Germany, it's particularly the case. The wage negotiation have been very pragmatic, right? To a point that, the value-added share between profit and wages is tilted a bit to the profit than to the wages in Germany as we speak. So a bit of rebalancing is not bad. Then the big question is, are there non-wage measures that could be taken? Shareholder participation schemes. How do you give, for example, one-off non-salary tax-free bonuses to people to avoid having a tougher negotiation of wages? I think we have a lot more policy options to discuss, on top of the central banks doing what they have to do to make sure that we don't get into a wage price spiral, which I said would be very complicated to manage in Germany because of the rigidities of the labor market.
Okay, here comes one question from Orion Malo, asking, in terms of interest rates, isn't demand essentially already substantially dampened because banks, private banks, are already increasing both interest spreads and lowering lending levels, especially with regards to real estate? Even if the ECB was to increase interest rates, would it have a huge effect on interest rates, on the market interest rates? I heard of banks quoting 3.x% for 10 years loans for housing, which were at 1.5% in autumn 21, which is really a phenomenon that we had a huge.
We see, this is, I think, of course, the market where we see the most housing affordability issue right now is the US, right? The cost of mortgage as a share of the median income has tripled already. So what Orion is mentioning here, I think we start to see it in the Eurozone, but we don't see it yet in the numbers because there is still very good access to financing for corporates and still very good mortgage access because the rates are low, they're fixed. It's a very different situation than in the US. Could it become a problem? Yes, we are very far from this. But what we see already, for example, on government yields is quite impressive, I would say. The Bund testing 1%, the Bono, the Spanish Bono at 2%, the BTP at 3%. So it is already quite huge, right? The fact that it's not completely translating the full rate scale is because we still have a lot of balance sheet interventions, right? The private banks have been saved by the COVID measures. The private banks have been, talk about a sovereign bank doom loop, yeah? We have a sovereign bank corporate nexus today because of the very strong COVID measures. That means that, it's still very cheap to get financing for a company in the market. It's still quite cheap to get a mortgage 20-year in Europe, even if you get, Orion mentioned 3% for 10-year loans for housing. I've not seen that. In my country, I think we're still around 1.5% for 20-year for housing, and we were at 0.7, 0.8, back in September, right? So it's a strong increase, but for such a low level that I think is still palatable, unlike the US, right? But it is a question, right? The question is whether it could actually trigger a much stronger adjustment on the whole rate scale. We're not there yet.
Okay, well, I saw that Detlef Ramsdorff has raised his hand, but so far I couldn't get a question from him. Mr. Ramsdorff, would you like to ask a question? Well, okay, so if that's not the case, I mean, we are already at the end of our session. Ludovic, thank you very much for this interesting talk. It was a pleasure to have you here. And I hope we can meet someday also in Frankfurt.
My pleasure.
It would be great. And thanks to all the participants. And we will have the next contribution to our Chief Economist series at, I think it's the 2nd of June. And we will have Mrs. Traut from Helaba, who will talk to us. We will invite the audience via email for the next session. Thank you all. Have a nice evening, a sunny evening, wherever you are. Thank you very much.
Thank you. Have a good evening.
Bye-bye.